Welcome to today's Explainer, everyone. I am looking at the boards right now and the entire energy sector is completely lighting up. We are talking massive geopolitical shockwaves and huge financial headlines hitting the wires today, and frankly, my head is spinning just trying to keep track of it all. Okay, we need to dive into this immediately because if you have absolutely any exposure to the market right now, you need to pay attention. We are seeing major structural shifts everywhere, and we've got to figure out what this actually means for our portfolios. With me today to break this all down is our Chief Investment Analyst. It is great to be here. The headlines are certainly screaming today, there's no doubt about that. But as always on this Explainer, our job is to look past the panic and the noise. If we dive into the data coming out of ExxonMobil's latest earnings and the broader market metrics, there are three real, fundamental causes hidden right behind these dramatic news cycles. Today, we are going completely by the numbers to understand exactly how a global integrated energy company actually digests this kind of macroeconomic and geopolitical turbulence. Wow, this headline is just incredible. Look at this. President Trump moves to reinstate the blockade of the Strait of Hormuz, and oil jumps immediately above $79 a barrel. The whole market is reacting to this in real time. But here is what is really confusing me right now. If oil prices are spiking like this, why isn't ExxonMobil stock going absolutely to the moon right this second? What is actually going on with their stock? Because looking at my account, I am expecting to see a rocket ship, and I'm just seeing the steady hovering. It doesn't make any sense.
Well, look, the market's reaction might seem completely counterintuitive if you are only looking at crude oil prices in a vacuum. But if you look at the data here, ExxonMobil is not just a crude oil seller. The ad hoc news reports explicitly note that ExxonMobil's stock reflects its role as a global integrated energy company. Their upstream production, their refining, and their chemicals operations support a highly diversified cash flow profile. That diversification is exactly why you aren't seeing massive volatile swings in the stock price today. The entire corporate structure is mathematically engineered to absorb these exact kinds of macroeconomic shocks.
Okay, wait a minute, doctor. Integrated energy, diversified cash flow profile? What does that actually mean in plain English for someone just looking at their investment app trying to figure out if they should buy or sell? Fair enough. Let's look at the roadmap for today's Explainer so we can logically uncover the truth hidden behind these dramatic news headlines. We have four distinct stages today. First, headlines and hidden causes. Second, financials and fundamental realities. Third, megatrends and economic moats. And finally, three future survival scenarios. Okay, that sounds like exactly what we need to clear the fog. I love a good structure, so let's jump right in. All right, stage one, headlines and hidden causes. So what you just said basically means the stock isn't acting like a meme stock today because they do a lot more than just pump oil out of the dirt. But I really need you to simplify this for me. Exactly. To understand the stock's behavior, we absolutely must understand the business structure. Exxon operates across the full oil and gas spectrum. Because they operate at every single step, a disruption or price spike in one area often acts as a natural hedge against another. Think of Exxon's integrated business model using a simple lemonade company analogy. It works in three parts. First, you have the upstream segment. This is like growing and picking the lemons. When lemon prices, or in this case, crude oil prices, spike to $79, the farmers making the lemons make a massive profit. Second, you have refining, or making the lemonade. The refinery actually has to buy those expensive lemons to make the drink. So when oil prices are high, refining margins can get severely squeezed because their raw material costs just went up. And third, you have chemicals, which is like manufacturing the plastic cups and the sugar.
Ah, I see. Okay, that makes it so much clearer. So if the price of lemons goes completely through the roof, the lemon growing side of the business is making an absolute fortune, but the lemonade stand side of the business suddenly has to pay way more for its ingredients, so its profits shrink.
Precisely. They balance each other out based strictly on internal economics, which is why an integrated model provides a diversified, steady cash flow profile for long-term investors, rather than wild, unpredictable volatility. Okay, but wait a minute, doctor. What does that have to do with our stock accounts right now? If the Strait of Hormuz is blockaded and crude oil prices are spiking over $79, shouldn't the lemon growers be making so much money that it just drags the whole stock up anyway? Why is it just totally flat? That is a critical question. The answer lies strictly in the numbers from their first quarter 2026 earnings presentation. While the upstream business absolutely does benefit from higher crude prices, a blockade in the Middle East also introduces severe logistical constraints and lowers global energy product throughput. It's proven by the numbers. The market is pricing in the reality that while Exxon will make more per barrel on the upstream side, they may be processing fewer barrels overall on the refining side due to the regional disruption. The market is waiting to see the actual financial impact.
Stage 2. Financials and fundamental realities. So what you just said basically means Exxon is essentially a giant financial seesaw. When the oil-producing side goes up, the refining side goes down, keeping the overall stock incredibly stable. I want to see the actual math behind this seesaw.
Let's look at the actual performance compared to the past and current market expectations. Let's look at the headline number right here. ExxonMobil reported a first quarter 2026 GAAP earnings of $5.7 billion. Now, it is absolutely vital to interpret the meaning of this number. This is not just gross revenue we are talking about. This is $5.7 billion of pure GAAP earnings in a single quarter. This mathematically demonstrates the sheer earnings power of their current corporate structure. Oh my gosh! $5.7 billion in pure earnings in just 3 months? That is a staggering amount of money. But wait, is that actually good compared to their history? Because I remember oil companies pulling in massive windfalls a few years ago. It is an exceptionally robust number when you consider the baseline context from the sources. According to their financial disclosures, this $5.7 billion comes after navigating scheduled maintenance impacts and normal cyclical downturns in chemical margins. They are generating this massive level of profit even before the recent $79 crude price spike fully materializes in the forward quarters.
Now, what is really interesting about this data is the cash flow from operations. If you look at the table, it sits at a massive $14.664 billion for the quarter.
Okay, wait, so they made $5.7 billion in earnings, but they generated almost $15 billion in cash flow. How does that even work?
Cash flow from operations adds back non-cash expenses like depreciation and depletion, which were significant based on the data. Those were $4.812 billion in the first quarter of 2026 alone. This $14.664 billion figure is the actual lifeblood of the company. It dictates exactly what they can return to shareholders. And if you look at the third line there, they executed $4.9 billion in share buybacks just in this one quarter. By systematically retiring shares, they are logically increasing the ownership percentage of every single remaining investor, and it is entirely supported by that massive operational cash flow.
Okay, playing devil's advocate here for the viewers. They are making $5.7 billion in a quarter. They have almost $15 billion in cash flow. They are buying back nearly $5 billion in stock. Why is the market going wild over companies with terrible balance sheets, while this company, which is practically printing money, sees such a flat market reaction? Why aren't investors just throwing their money at this? The market is fundamentally a forward-looking mechanism that prices in risk. While the current numbers are stellar, traditional energy investors are acutely aware of cyclical volatility. They know that a $79 oil price today could easily be $60 tomorrow if geopolitical tensions suddenly ease. The flat reaction is the market demanding mathematical proof that Exxon can remain highly profitable even if crude prices suddenly drop. And if you look at the data, Exxon has actually engineered a mathematical solution to that exact fear. Look at this figure on the screen, $15.6 billion. This is the amount of structural cost savings ExxonMobil has achieved cumulatively since 2019.
$15.6 billion just in savings? That sounds completely absurd. No way.
It sounds absurd, but it is right there in their first quarter disclosure. More importantly, we have to interpret its level compared to competitors. This $15.6 billion in structural cost savings is more than the cumulative structural cost savings reported by all other integrated oil companies combined, based on public filings. This isn't just about spending less money on paperclips, it represents a permanent lowering of their break-even point. It means that even if the $79 barrel drops significantly, Exxon retains a massive profit margin buffer that its competitors simply do not possess.
Wow, okay, that is massive. And this brilliantly illustrates why they are so stable. But let's get back to the breaking news hitting the tape today. Oil is at $79. How does that directly translate to their bottom line? I want to know exactly what $1 extra on the barrel does to this company's bank account.
We can calculate that exactly without any speculation. According to the exact earnings sensitivities chart from the source data on the screen right now, for every $1 per barrel increase in Brent crude, ExxonMobil's annual earnings increase by $700 million in the upstream segment.
Wait, $700 million for a single dollar change in the price of oil?
Yes, that is the leverage of their scale. And on the refining side, what we call energy products, an indicative $1 per barrel increase in the refining margin adds $800 million to their annual earnings. Furthermore, a $100 per ton increase in North America polyethylene prices adds $560 million to chemical earnings. These exact sensitivities allow us to logically calculate the actual financial windfall of the current market conditions, completely removing speculation from our analysis.
Stage 3. Megatrends and economic moats.
So what you just said basically means they've slashed their operating costs by more than the rest of the industry combined, making them essentially bulletproof, and every $1 increase in oil hands them almost $1 billion in pure profit. Incredible. So what makes this company untouchable in the long run? What is their actual irreplaceable weapon?
To understand their economic moat, we have to look at their unique, high-return assets that competitors simply cannot replicate. Exxon's strategy isn't just to drill for oil. It's to build a uniquely advantaged portfolio with a strictly low cost of supply. And the crown jewel of that strategy right now is located in Guyana. Take a look at this. This is the Payara FPSO, a floating production storage and offloading vessel stationed in Guyana. Okay, that is a massive, highly complex-looking ship. But why is this specific boat considered an economic moat? The operating metrics prove it. In the first quarter of 2026, their Guyana FPSO performance achieved industry-leading operational availability. This isn't just about having oil. It is about extracting it with a level of reliability and low operating costs that is currently unmatched in the industry. As CEO Darren Wood stated in the earnings call, their focus is to generate an advantage project with advantaged returns and a low cost of supply, competitively positioned in the world supply portfolio. Guyana is the physical manifestation of that moat. It pumps highly profitable barrels regardless of global economic cycles.
Okay, I get that Guyana is an incredible, irreplaceable asset, but let's get back to today's news. The market is panicking about the Hormuz blockade right now. How does this geopolitical risk actually hit our stock accounts today? Are we exposed or not?
That is exactly the right question to ask, and we will answer it strictly using the data provided in their second quarter 2026 key items forecast. We do not speculate on politics. We analyze the barrel impact based purely on the facts.
Breaking down the exact projections, a Strait of Hormuz closure for the entire second quarter would have three specific impacts. 1. It would reduce Middle East production by approximately 800,000 oil equivalent barrels per day, or KOEBD, compared to 2025. 2. This logistical bottleneck is mathematically expected to lower global energy products throughput by 2% versus the fourth quarter of 2025.
Okay, so that is a massive hit. 800,000 barrels a day just vanishing from the board. But what about Guyana? Does that help offset this at all?
Exactly. Point 3. Non-Middle East impacts, which includes their advantaged assets like Guyana, are expected to actually increase production by approximately 150 KOEBD versus the first quarter of 2026. So while the Middle East risk is mathematically quantified, their geographical diversification, their moat, automatically kicks in to partially offset the production losses elsewhere.
Stage 4. 3 future survival scenarios. Understood. The pain in the Middle East is cushioned by the gains in Guyana. That diversification is key. Now let's bring this home. Doctor, the viewers need clear grounds for making investment decisions today. Tell us exactly what the future looks like based on these numbers.
We will break this down into 3 strict scenarios: a bull case, a bear case, and a base case, defining the exact triggers for each based on the first quarter data and second quarter projections. Here is the optimistic scenario, the bull case. This triggers if the Strait of Hormuz blockade is short-lived but permanently elevates the risk premium on Brent crude. In this scenario, oil holds around $80 to $85, Exxon's non-Middle East assets scale up by that 150 KOEBD, and remember our sensitivity metric. Every $1 increase in Brent adds $700 million to annual earnings. The stock price would likely react very positively as they harvest massive upstream profits without suffering long-term throughput declines.
Okay, and what about the bear case? What is the fatal weakness here that could sink this?
The bear case triggers if the blockade persists for the entire quarter or longer. In this situation, the roughly 800K OEBD of Middle East production remains offline. Furthermore, the global energy products throughput drops by more than the projected 2%. If this bottleneck leads to a global recessionary environment, severe demand destruction occurs, tanking refining margins entirely. The stock would face downward pressure as the integrated seesaw breaks down, meaning they have high raw material costs, but no one is buying the refined products.
Wow, that bear case is absolutely terrifying for the broader market. But let's be rational. What is the base case? What is the most likely reality based purely on the data we have right in front of us today? The base case is highly neutral and stable. The diversified cash flow profile simply holds steady. The upstream gains perfectly offset the refining margin squeezes. Most importantly, that unparalleled $15.6 billion in structural cost savings acts as an immense risk buffer, ensuring profitability regardless of minor throughput fluctuations. And finally, with $14.6 billion in operating cash flow, their $4.9 billion quarterly share buyback program will seamlessly continue through the volatility, providing a constant mathematical floor for the stock price.
So what you just said basically means that while the headlines are screaming and traders are panicking, the fundamental math proves that Exxon is essentially a fortress built to weather exactly this kind of storm. It perfectly brings to mind a famous quote, "The stock market is a device for transferring money from the impatient to the patient," by Warren Buffett. If you are patient and actually look at the cash flows and cost savings, the picture is incredibly clear. Logically, based strictly on the facts from their disclosures, the data supports that conclusion entirely. Thank you for breaking that down so clearly, Doctor. And thank you all for watching today's Explainer. Your subscriptions, likes, and supportive comments are a huge encouragement for our video production. But I will leave you with this final provocative question to ponder. If Exxon is this wildly profitable during a global crisis, what happens to their massive cash pile if geopolitical tensions actually disappear tomorrow? Let us know what you think in the comments. We will see you next time.